Most traders see momentum, but only a few know how to use it without destroying their capital. In the next few minutes, you'll understand why studying momentum properly can completely change the way you trade. While many legendary momentum traders focused mainly on price and volume, a few important names played a key role in developing and promoting two of the most widely used momentum indicators, RSI and MACD. Gerald Apple is known as the inventor of MACD. In the late 1970s, he created this powerful indicator and actively promoted its use among traders. J. Wells Wilder Jr. invented the Relative Strength Index, or RSI, in 1978. He introduced it in his influential book New Concepts in Technical Trading Systems, which went on to become a classic in technical analysis. Alexander Elder strongly promoted the use of MACD. In his well-known book Trading for a Living, he featured MACD prominently and showed traders how to combine it with other tools. And Martin Preing, a respected technical analyst, was a strong advocate of momentum indicators. He extensively promoted the use of RSI, MACD, and other momentum tools in his work. These four names helped shape the way traders understand and apply momentum indicators even today. In the next few minutes, I'm going to show you exactly how to recognize that force, and more importantly, how most traders keep confusing movement with momentum and pay the price for it. If you've ever entered a stock because it's moving, and then watched it reverse on you, this video is going to hurt a little. In a good way. Stay till the end. By the time we're done, you'll never look at a rising candle the same way again. Welcome to Titiksha Finance. Let's begin. In physics, momentum is simple. Mass times velocity. An object in motion tends to stay in motion until a stronger force stops it. Markets work the same way. Price has velocity, how fast it's moving. Volume and participation act like mass, the weight behind the move. When both align, you get real momentum. A stock that is already moving with strength doesn't reverse easily. It keeps going until a genuine opposing force appears, heavy selling, negative news, or a clear structural break. Just like in physics, you don't fight momentum. You either ride it or step aside. This is why trend following and momentum strategies work. They respect the existing force instead of trying to predict the next one. But remember, momentum is not permanent. Every force eventually meets resistance. The skilled trader's job is not to invent direction. It is to measure the strength of the current move and exit when that strength begins to fade. Momentum is not just price is going up. Momentum is the strength and speed with which price is moving, and more importantly, the conviction behind that move. Think of it like this: a car can slowly roll downhill, or it can accelerate with full power. Both are moving. Only one has real momentum. In the market, you will often see stocks rising on thin volume, weak candles, and no real participation. That is not momentum. That is just noise. True momentum has weight. It has participation. It has urgency. When real momentum arrives, the market doesn't ask for permission. It simply moves. In trading, as in physics, the path of least resistance is usually the one already in motion. Observe. Align. Don't force. There are three types of momentum you must learn to see together. First, price momentum. This is the raw movement of price. Higher highs, higher lows, expanding range. The market is clearly choosing a direction. Dow theory of spotting higher high or lower low is a way to confirm price momentum. Second, volume momentum. Price without volume is like a body without blood. When strong directional candles appear with rising volume, the move has life. A rising volume on buy or sell is a way to check momentum. Third, indicator momentum. This is where most traders get confused. Indicators do not create momentum. They only measure it. This is the fundamental difference between the momentum indicators and other two indicators. Within the momentum indicators, there are two clear categories. Bounded indicators like RSI, stochastic and CCI. These move within fixed limits, usually between 0 and 100. They tell you the relative strength of the move. They show when a move is becoming stretched. Unbounded indicators, like MACD histogram, rate of change, and the momentum oscillator. These have no upper or lower limit. They simply measure the speed and acceleration of price. The higher or lower they go, the stronger the force behind the move. Price and volume show you what is happening. Bounded indicators show you how extended it is. Unbounded indicators show you how powerful it is becoming. Most traders look at only one. Professionals look at all three: price, volume and indicators, and wait for them to align. When price is moving, volume is supporting, and both bounded and unbounded indicators confirm the strength. That is when real momentum is present. When we talk about momentum indicators in technical analysis, one of the most important ways to categorize them is by whether they are bounded or unbounded. Let's start with bounded momentum indicators, also known as banded or range-bound oscillators. These indicators move within a fixed range, most commonly between 0 and 100, or sometimes from -100 to 0. Because the scale is fixed, overbought and oversold levels become very clear and consistent across different stocks, indices and timeframes. Some of the most popular examples are RSI, or Relative Strength Index, which moves between 0 and 100. Readings above 70 are generally considered overbought, and below 30 are oversold. Stochastic oscillator, also ranging from 0 to 100. Here, above 80 is overbought and below 20 is oversold. Stochastic RSI, a more sensitive version of RSI. And the ultimate oscillator, which also stays within the 0 to 100 range. These bounded indicators are excellent for spotting overbought and oversold conditions. They work best in sideways or ranging markets, are easy to compare across different instruments, and can stay overbought or oversold for long periods during strong trends. Now let's look at the second category, unbounded momentum indicators. These have no fixed upper or lower limit. Their values can expand or contract freely, depending on how strong the price movement is. Popular examples include MACD, which is widely used for momentum direction, crossovers and divergences. The momentum indicator itself. Rate of change, or ROC. Commodity Channel Index, or CCI, although traders often use plus or minus 100 or plus or minus 200 as reference levels. And PPO, the percentage price oscillator, which works similar to MACD but on a percentage basis. Unbounded indicators are better at measuring the actual strength of momentum. They are more useful in trending markets. Overbought and oversold levels here are relative, not fixed, so you need to look at the historical extremes of that particular instrument. They are also excellent for divergence analysis. Here's a quick comparison. Bounded indicators have a fixed scale. Unbounded ones have no fixed limits. Overbought and oversold levels are clear and fixed in bounded indicators, while they are relative and visual in unbounded ones. Bounded indicators work best in ranging markets. Unbounded ones perform better in trending markets. Bounded indicators are easy to compare across instruments, while unbounded ones are more difficult because their scale depends on the price level. Let me highlight a practical tip. Most experienced traders don't rely on just one type. They use both together. For example, they may use MACD, which is unbounded, to understand the overall momentum and trend direction, and then use RSI or stochastic, which are bounded, to fine-tune their entry and exit points within that trend. Understanding this difference between bounded and unbounded momentum indicators can significantly improve the way you read market strength and timing. To summarize, I recommend analyzing price, observing volume, checking MACD and seeking confirmation on RSI to spot a trade. Here's how you spot real momentum on the chart. First of all, we should check the price confirmation. Look for strong directional candles, preferably consecutive. Different traders use different candle, bar, or line chart methods. For example, outside bullish or bearish, hanging man, dark cloud, etc. Check the structure. Are we making clean higher highs and higher lows? Or is the move messy and overlapping? Dow theory could be a method used to check this. Second, see volume expanding with those candles. Quiet volume on a big move, uptrend or downtrend, is a warning. Rising volume is confirmation. Third, check bounded and unbounded momentum indicators. I use RSI and MACD to validate confirmation. Finally, look for broader participation. Is the sector moving? Is the index supporting it? Isolated momentum dies quickly. Supported momentum lasts longer. For example, when Nifty breaks a key resistance with strong candles, rising volume, and banking or IT stocks also moving, that is institutional momentum. When a random stock shoots up 8% on low volume while the market is flat, that is usually a trap. Learn to distinguish the two. Now the hard truth. Most traders lose money on momentum not because they don't see it, but because they arrive late. They wait for the move to become obvious, then enter when the risk-reward is already poor. They ignore volume. They use 5 indicators, and still feel confused. They force trades in sideways, low-momentum markets, simply because they are bored. And the biggest mistake. They stay in the trade even after momentum has clearly faded, hoping it will come back. Hope is not a strategy. Momentum is temporary. Respect its life cycle. Momentum is powerful. But power without patience becomes destruction. We do not chase every moving stock. We wait for the market to show its hand clearly. We wait for price, volume, and structure to align. We enter when conviction is high, not when excitement is high. And when momentum starts fading, we exit with the same calmness with which we entered. No drama. No hope. No ego. In the long run, the trader who waits for high-quality momentum setups will always outperform the trader who is constantly in the market. Patience is not passive. Patience is selective aggression. That is the edge. Let me leave you with this. Momentum is the force behind the move. Not every rising stock has it. Not every falling stock has lost it. Learn to see the difference between movement and momentum. Use price, volume, and a couple of clean indicators. Wait for alignment. Respect the life of the move. And above all, trade with Tatiksha. Calm. Disciplined. Selective. Now tell me in the comments. Do you currently wait for momentum to become clear, or do you still find yourself chasing? I read every comment. If this video gave you clarity, subscribe and turn on the bell. Stay disciplined. Stay patient. This is Tatiksha Finance, signing off.